With the economy becoming more and more shaky, inflationary trends rising, and massive layoffs likely on the horizon, everyone needs to have a diversified source of income. Passive income, where your money works for you, is one of the best ways to secure your financial future. And guess what? Investing in dividends is your best bet. Not only will you be able to amass a lot of money from it, but you can also buy it, hold it for decades, and live off it even when you're long retired. Last year alone, Berkshire Hathaway earned more than $4 billion in dividend income from just 5 positions. With such effortless earnings, it's one of the reasons why Warren Buffett banks on dividend investing so much. As a matter of fact, not investing in dividends at the age of 11 is one of the things he regrets so much. Here's what he said about it.
I spent $114.75. We had 3 shares, $114.75. If I put that $114 into the S&P 500 at that time and reinvested the dividends, think of a figure as to what it would be worth today. Oh man, $400,000 today, one person's lifetime.
But here lies the million-dollar question. How much of an investment do you really need to have to be able to completely live off of dividends? Here's a hint. The answer is way less than you'd actually expect. But before we get into that, let's have a hearty discussion on why you need to live off dividends in the first place. After all, there are many different ways to make money. To start with, investing in dividend stocks is super convenient. In publicly traded companies, profits will always be paid out to their shareholders, which are you, because purchasing a stock makes you one of the beneficiaries. And guess what? Some firms even pay out quarterly. Imagine a company like Apple, which is always at the top of annual sales charts and makes a lot of profits, paying you regularly. What could be better than that? Now get this. According to a recent survey, the average age for male retirement is 65. So, imagine you finish college at the age of 22, and 3 years later, you began to get well-paying jobs. No matter what you earn or do, you're more than likely to hang up your boots in the next 4 decades. Yep, only 40 years. Imagine bending over backward and working your whole life just so that you could enjoy a few decent years of retirement. We know it's a bit sad, but that's the harsh reality a lot of people are currently facing. So now, why don't you be a bit pissed off and ask yourself this question? Do you fancy the idea of working for 4 decades just so you can have enough to retire at 65? If not, why don't you take the proactive step towards changing your financial future? It's no longer news that there are many ways of earning loads of money passively, like renting out homes and equipment. But let's just be real for a second. There's nothing quite as simple or relaxing as having money just go straight into your bank account without moving a muscle. When it comes to investing in dividend stocks, all you need to do to make money is a one-time investment in the right company. You'll be making enough money to keep you working part-time, or better yet, retire early, instead of dedicating hours to a job that's not only stressing you out, but also taking a lot of years from you. However, like we just said, it's got to be on the right track with the right company. A lot of mistakes people make when investing in a firm are that they fail to consider the future. It's not just about how much you make today. What about tomorrow? What about the day after that? Always pick the firms that are built to last and have a proven track record of paying great dividends over a long period of time. But hey, you don't have to simply take our word for it. Here's what the Oracle of Omaha has to say.
Well, the biggest mistake they make is listening to a lot of other people and buying something because they think it's going to go up next week or next month. And for whatever reason people give you, you should understand what you buy.
Moving on, let's dive right into the calculations of how much money you need to invest in order to live off dividends. To begin with, there's a common misconception that a lot of people have regarding dividend investing. While they believe it requires a significant amount of money, and we're talking millions of dollars, the truth is that they're failing to see the bigger picture, or should we say, the smaller one. To know the lowest amount of money you need to live off dividends, you need 2 things in mind: your total cost of living for a year, and the kind of dividend yield that you can feasibly achieve. This is usually between 1 and 6%. Now, for the practical aspect, Let's say you earn around $4,500 a month. With 12 months in a year, you'll need to make around $54,000 to be able to live off the dividend income alone. And with that in mind, let's go on to the next phase, which is estimating your dividend yield using one of Warren Buffett's favorite stocks. Have you any idea about the company we're referring to? Here's an interesting statement he made about it.
Apple, has a position with consumers where they're paying, maybe they pay $1,500 or whatever it may be for a phone, and these same people pay $35,000 for having a second car. And if they had to give up a second car or give up their iPhone, they'd give up their second car. I mean, it's an extraordinary product. We don't have anything like that we own 100% of.
Apple's stock price sits at $176.65 per share, with the dividend yield being approximately 0.54%. If we factor that into the past equation, it means that the amount you'll need to invest to live off dividends is approximately $10 million. But how about another great company like Johnson & Johnson? Theirs was around $151.34 a share, with a starting dividend yield of 3.15%. Want to know how much you'll need? An excess of $1.7 million. To be blunt, those are the reasons why many people shy away from investing in dividends. The amounts are simply way too much. But thankfully, there's a silver lining. You can live off dividends with far fewer investments than any of the examples we just talked about. One of the first things people typically get wrong when they try to estimate how much they'll need to live off dividends starts from the very beginning, understanding their true cost of living. Take a deep breath and consider the past example we gave of estimating $4,500 as a monthly cost of living. Were you able to figure out what the mistake was? We didn't consider inflation. Looking over a span of 30 years, with an average inflation rate of 2.5%, your monthly cost of living will end up being around $7,250. If you had to invest $10 million in dividends to Apple and $1.6 million to Johnson & Johnson, just think about how crazy it'd be at the end of the 30-year span when inflation has made your cost of living even higher. However, what about high-yielding dividend stocks? After all, a lot of people flock to it because of the high returns. Could it be the best and fastest way to live off dividends? Before we dive into this section, walk with us for a bit. Are you aware that high-yield investments typically have lower price growth rates? Basically, both the stock price and the dividend yield are in what the experts call an inverse relationship. Here, if one goes down, the other tends to go up, making it fairly risky. People who pick stocks for their increasing yields could accidentally acquire assets that are dropping in price, which is a quick way to lose money. Always read between the lines. Whenever you see a ratio that has been steadily increasing for a decade, have it in the back of your mind that the business is maturing healthily. On the flip side, if the ratio sounds too good to be true, it likely means that the company is paying out more than it can sustain, meaning the juicy incentives won't last long enough for you. Guys, if you're going to live off dividends from your portfolios, you must ensure you do due diligence to ensure those dividends last. To address this, always remember this well-aged advice from Warren Buffett on dividend policies. Above all, dividend policy should always be clear, consistent, and rational. Anything other than that should be a red flag. With that in mind, let's consider Home Street as an example that has a decent history. With a current share price of $6.50 and a starting dividend yield of 6.3%, you'll still need about $850,000 in investments to live off of dividends when you have an annual cost of living of $54,000. And guess what? Even if we assume we're going to get a price growth rate of 3% with a dividend growth rate of 0%, given that high-yielding investments typically don't have high dividend growth rates, we'll still end up needing more than $800,000. Granted, it's way lower than $10 million for Apple and $1.7 million for Johnson & Johnson, but do you realistically believe you can afford that? If not, let's keep the calculations going until we find a healthy long-term solution. But how about we consider another approach using different parameters? This time, we're going to reinvest the dividends we got from an imaginary high-yield dividend stock with a yield of 7.5%. a 2% price growth rate, and a dividend growth rate of 0%, just for example. Also, we'll be having monthly contributions of $1,000. First things first, do you still remember how inflation took our cost of living to $7,250 over 30 years? What if we told you that even if you decided to reinvest everything you got here over that time period, you'd still be getting under $5,000 a month? Well, that can be pretty disappointing. It is nothing but another harsh reality. Moving on, let's mix things up a bit by trying a dividend growth investing strategy this time. Just in case you weren't aware, when it comes to dividend growth investments, we typically see higher price growth rates. This time, let's imagine the stock has a price growth rate of 7%, a dividend growth rate of 9%, and a starting dividend yield of 3.5%. With our usual monthly contributions of $1,000, something interesting is going to happen. While you won't even be getting up to $2,000 in the first 2 years, things will dramatically shoot up over time. But would it be enough to make you live off dividends alone? With the 2.5% annual inflation that is compounding, the answer is going to be no. While you will be earning around $6,000 in dividend income at the end of every month from this imaginary company, you won't be able to afford your monthly cost of living, which is around $7,250 alone. However, what do you think is going to happen if we decide to tweak things a little bit by reinvesting all of our dividends over a 30-year period? Surprise, surprise, for the first time out of all these possible scenarios that we have considered, you will be able to maintain your monthly cost of living from your dividends. However, there will be a catch. From the first year up to the 20th, your monthly cost of living will still be above your dividend earnings, making it hard to live off of. But things will start to take a turn after that. Your monthly dividend payments will eventually surpass the cost of living. And here's where things get interesting. While you'd have needed to invest up to $1.7 million in Johnson & Johnson dividend stocks, you'll need less than $300,000 this time around. Yep, you heard that right. That's a difference of $1.4 million over the same 30-year period. Ladies and gentlemen, this is the amazing magical power of compounding in full swing. While most people still believe the fastest way to avoid your cost of living and live off dividends alone is by investing in high-yield dividend stocks, it's safe to say that we can all see why that isn't even close to the truth. When you reinvest in stocks that up their dividend game each year and keep on reinvesting those dividends instead of spending them, the growth can be quite staggering. However, don't forget to keep taxes in mind when figuring out your dividends. Whether it's from stocks in a 401k, IRA, or a regular brokerage account, each of those dividends will be considered taxable income and subject to different tax rates. Additionally, while you wouldn't need to pay for taxes if you reinvest them in a traditional retirement account, the situation will be different should you decide to take that money out. You'll start to get taxed at regular income rates. Secondly, whenever you take out your dividends from a taxable brokerage account, you'll receive one of the two tax treatments, depending on whether they are qualified or ordinary. While the former is taxable at the discounted long-term capital gain rates of 0%, 15%, or 20%, the latter will be taxable at ordinary income rates, which can range from 10% to 37%. However, you might want to get personalized tax advice from tax experts like a certified public accountant regarding the investment strategy that you want to pick. Also, try as much as possible to be updated with anything the IRS has to say about dividends. In a nutshell, while tax considerations will undoubtedly make it difficult for you to model the exact amount of money or time that you'll need to be able to permanently start living off dividend earnings, the best and safest way to keep it in check is to add an additional 10 to 20% to the total amount of contributions that you'll need to make. It might be a bit difficult at first, or even overbearing, but take solace in the fact that as your income grows over the years, so will your portfolio contributions. And guess what? When that happens, best believe that you will be living off dividends soon enough.